Hello and welcome back to the show. Today we're going to be talking about the big long. We're going to be covering the GameStop GME short squeeze alongside some other meme stocks, the WallStreetBets community, and Robinhood trading halts. And we're going to be given a news update, catch up, and some kind of analysis on what's going on. Specifically, we're going to be covering hedge funds shorting GME, the mechanics of a short squeeze, and essentially how WallStreetBets is involved, potentially profitably. We're going to also be covering Robinhood's halts trading, and we're going to be asking the question whether this is actually market manipulation. And then actually finally, we're going to kind of talk about unsophisticated amateur investors, as they're called in the media, and should we regulate or educate? But either way, I want to say a big welcome to 2021, where in just 3 weeks, capitalism has redistributed more wealth than socialism could in 20 years. So we're definitely set for an interesting year, but we're going to kind of jump straight into what's been going on. So obviously, as the news is definitely not short of these headlines, which some of you've probably heard, hedge funds have shorted Gamestop. They shorted, I believe, AMC. There were essentially a few short positions placed in some of these meme stocks, as we call them now, whereby what these hedge funds do to short the stock is that they borrow the stock initially, and then they sell it on the market to purchase it back at a future date, potentially for a lower price. They keep the difference as they purchase back the stocks and give it back to whoever they borrowed it from. However, what was special about these stocks was the over 100% short interest. And this is essentially showcasing that out of the publicly available float of shares, however many that might be, I think in GameStop it's 50 million, there was over 100%, around 140% initially of the public float shorted. And you might ask yourself, how can you short or sell more stocks that are on the market? That's a great question. Potentially what could have been involved is an activity called naked shorts, and that is essentially selling stocks that you don't have. I don't know exactly how the mechanics of that work. I'm pretty sure it's not meant to work that way. You shouldn't be able to sell something you don't have, but nevertheless, that was done potentially. But whether or not that was the case specifically with what these hedge funds were doing, what we saw is that these firms were, especially with GameStop, at a very low stock price. And a user from WallStreetBets, the subreddit called Deep Fucking Value, posted actually a video on, I think it was around the time of July 2020, when GameStop was about $4. Stating that he's buying call options, and that is, he's being bullish on the price. His argument was that, for these hedge funds at that time, they were placing more shorts on the GameStop. For these shorts to become profitable, something catastrophic would have to happen. And based on the analysis that Deep Fucking Value did, essentially he assumed that this is the hedge funds have essentially overstepped their boundaries. They've become way too greedy, and their kind of recklessness is what he can profit off of. And obviously this has been in the news over a long time. I think Michael Burry has been another name that's been involved in this. That's the guy from the 07-08 crash, the guy who predicted it, very famous for that. And so obviously you have a lot of news outlets attaching his name to what is going on. But nevertheless, so Deep Fucking Value purchased some call options, and he started posting on the subreddit on WallStreetBets. I think if you can go on his profile, he's been posting for about a year and a half monthly updates on his call positions. It's quite an interesting read. You can even see, from a year ago or something, a lot of the comments that he was getting, which were very few, people were telling him he's an idiot, that he should, hopefully he is sold already, but he's held and obviously become, quite well known for it. Nevertheless, enter WallStreetBets, and essentially that's a forum where before this kind of phenomenon, as you may call it, it wasn't very well known, especially in the public eye. It was a public forum, the subreddit of just under 2 million users. And these guys were essentially, high risk, high return traders. It's a place where it was mainly an options focused community where people sent their money to burn, really. For them, I guess it's a lot of memeing and talking about how investing is a bit like gambling. And nevertheless, yeah, it kind of relates back to the high risk, high reward trades. And so what WallStreetBets did is they picked up on this kind of GameStop thing, the overreach of these hedge funds, and alongside Deep Fucking Value, said that, okay, we're going to go in on this because, again, high risk, high reward. What if GameStop does go up and these hedge funds are short, very short, over 100% short, interest short? That's going to be a lot of money for us. And so, yeah, the mechanics of the short squeeze when it comes to that is that what's WallStreetBets doing now? And like I mentioned, actually, initially there was just under 2 million users. Now, over the past week or two, or since January, so throughout January, that has increased to now, I think, 7.5 million users. So it's completely exploded. It's beyond ridiculous how popular this movement really has gotten. But we'll touch more on that later. Nevertheless, what these users now are hoping to do is increase the price so much of the shares by buying stocks and call options that when the hedge funds come to having to buy these stocks and honor their borrowing contracts, wherever they borrow their shares from, they're going to have to give it back at some point. If these guys just hold on to the stocks, hold on to the options, they're essentially going to be left with, the hedge funds are going to be left with having to buy whatever amount of stock that they need at, whatever prices market deems. Again, it's a small cap. I think there's 50 million available stocks. So it's a very small market, and it's why the price has shot up, for example, from $17 to up to 500. I think it was maybe intraday, like 468 on one specific day. It's fallen a bit back down now. We'll see how it moves throughout the next week. But nevertheless, that was the idea. It's the short squeeze. It's the purchasing of these stocks with the intention of then, because of this small cap, it being essentially a bottleneck problem, smoke out these hedge funds which have overstepped and make money from them. That is kind of the idea that they're going on about. And from then, when this gained some public popularity, was alongside the first media attention when Melvin Capital and Citron Research started to suffer big. I think within the first few days or week, or when GameStop started going up, because it didn't just shoot up from $4, $5, $6, $10 to 500, it progressively increased. And I said progressively, it was almost from one day to the next. But nevertheless, as the price started to climb and then essentially spike, Melvin and Citron suffered, and they suffered about, when the news first broke, about $5 billion together. And I do know that Melvin has been bailed out. Melvin's been, the name Melvin Capital has been all over the news, and essentially they were bailed out. That they got just on the $3 billion US injection from Steve Cohen of Point72 and Ken Griffin of Citadel. If you don't know who Steve Cohen is, I suggest reading up on the book called The Black Edge. Essentially, he is, although I don't think it was proven in court, he wasn't indicted, or whatever the terminology is. Their business is inside their trading and essentially making money whatever way it is. These, I don't want to say these kind of people, but there is a certain notion. Some people, people against Wall Street have the opinion that these guys would sell their own mother for a higher bonus the next year. But nevertheless, it kind of, that's when, from the eyes of WallStreetBets, upon this bailout, essentially, it became an us versus them fight. That there were slogans of like eating the rich, which, as ridiculous as it may sound, is the opinion that a lot of people took. And funnily enough, now if you go on the subreddit, people are saying, oh, it doesn't even matter if I gain or lose money. It's about sending a message. So it's become, this WallStreetBets movement has become more of like a religion almost against these wealthy Wall Street titans, the hedge funds. But it's getting pretty crazy. And actually, I'm going to share my screen now for the audio version. I'm just going to read out the news article that I'm kind of going to be referring to. But just a few hours ago, the news broke that what we see here, hedge fund Melvin sustains 53% loss after the Reddit onslaught. And so the firm was essentially hit with $4.5 billion US fall in assets after, partially, mainly the GameStop short squeeze. And what happened was that, the New York-based hedge fund, sustained a $4.5 billion fall in its assets from the end of last year, when it was, it went down to, now it's gone down to, I believe, $8 billion. And this is even after the just on the free $2.75 US billion cash injection from, as I mentioned, Steve Cohen and Point72 Asset Management, and Ken Griffin Citadel. Citadel is Point72 Asset Management. Is Steve Cohen's hedge fund, and Citadel is essentially one of the biggest, if not the biggest, market maker when it comes to the buying and selling and trading, essentially, of securities. So these are two very big giants, and one might ask, why have they gotten involved in this bailout or equity injection, whatever? Cash injection. Again, shared interests. Potentially they have some, potentially there is money to be made or alternatively lost from all that is going on. And I do know that the hedge fund, the founder of Melvin Capital, Gabe Plotkin, used to work with Steve Cohen. He used to work in SAC Capital Management or whatever the SAC, SAC essentially was Steve Cohen's previous firm which got shut down for, I think, problems when it came to insider trading. But nevertheless, some shady trading activity. That's where they know each other from. And this is why, when it comes to like these social circles, this kind of social circle, shared interest, friends, buddies kind of dynamic might explain why these individuals got involved. But yeah, that's that. I'm going to stop sharing my screen now. Okay. And this is where the media picked up this kind of fight that was going on. And I mean, this is all happening, from one day to the next. It's pretty insane. But what happened next is, really the next day, is Robinhood and some other brokers, they halted trading of certain securities. I believe it was GME and 12 or other 13 securities in when it came to Robinhood. To a certain extent, you can argue a red herring when it came to the blocking of trading of other securities, as GameStop has been very much the problem of some of the hedge funds and the elite investment community when it comes to kind of their pockets and their wealth. But it's important to know, and when it comes to assessing whether this is market manipulation or not, it's important to know that Robinhood blocked the buying of GME, for example, and let's just stick to GME. So they still permitted people within their accounts and on their platform to sell the stock, whatever, but they didn't allow them to purchase the stock anymore. And this is quite shady, and I'm going to explain it from the perspective of an order book, what that is, and essentially how they thinned the order book and how that can be perceived. I mean, how to a certain extent that is genuine market manipulation, aside from the reasons for which Robinhood halted the trading, which I'll also get to. It's very important to cover that. But anyways, I'm going to share my screen again. Yeah, so essentially the order book, as we see on the right here, is the order flow, all of the bids and all of the asks. So all of the purchases, all of the orders to purchase a stock and all of the orders to sell a stock, right, respectively. And so what happens here is that Robinhood's business model is not they don't make money from the people on their platform trading freely as they wish. When Robinhood mentions that they want to protect their customers, they're not talking about the people of the accounts necessarily. What Robinhood does and what allows them to commit to commission-free trading, which again, that there is no thing such as a free lunch. The explanation here is that what Robinhood does is that they collect the order flow, essentially, of all of the orders from the people on the platform with their accounts, whatever that may be. And recently, that was a lot of buy GME orders. Right. And so what they do is they bundle them up and they give them to Citadel, which is their customer. The clients on Robinhood's platform are their product, right? Their orders are their specific product. And so they bundle all of these orders together. They sell it to Citadel. And, via the kind of economies of scale, they essentially enable Citadel to execute all of these orders at once, as opposed to, Robinhood essentially filing off the orders one by one at a certain time, at a certain period of the day. They sell these orders to Citadel, and Citadel can actually front run these orders anyways. I mean, they know the trading volume. They have the data on people's orders, right? They know what might be able to move the markets. What are the specific bid and asks of whatever. So it's insider trading again, but just with a bit of glam. It's again, platforms like Robinhood are a bit more new, but they have themselves said that they're pioneering the space they're in. But nevertheless, anyways, what Robinhood does is they collect the orders. This order flow goes to Citadel. They execute, right? And what we can observe from here is on the order book, as we see on the right of my screen. I'm actually going to zoom in specifically to the order book, is we see the orders to purchase, i.e. the bids on the left and their density. and the orders to sell, which is the asks for the on the right. And so as you can see on the bottom on the x-axis, there is the price, and on the y-axis you have the trading volume, right? Now this isn't necessarily, if this is just an audio version that you're listening to, this will make sense just via whatever I'm saying. Essentially, what you see in a normal order book is that the more orders there are to buy or sell, the more money it's going to take to move the price, right? Because at each price level, you're going to need to either purchase, in one way or another, honor these contracts, whether that's to sell or to buy, clear these contracts, and move on to the next price level, right? If 100 people want to buy some stock at $100, you're going to need 100 times 100, 10,000, let's say US dollars to clear that level, if I got the math correctly, actually. You're going to need that amount of money to clear that level, and essentially that's going to move the price, right? So when you have a lot of, for example, and this is what caused GameStop's price to initially spike a lot, because people just wanted to buy. People wanted to buy, they wanted to purchase call options, buy. That's all they did. And because the hedge funds had already shorted so much of the stock, there was a lot of buy orders or bids, and there was very little sell orders or asks. And so it was easy for the price to move up so much because there wasn't many people selling. There was an insane amount of people buying. And so with the trading hold, what Robinhood did essentially is close the tap on the bids, close the tap on the buy orders, because a lot of them came from Robinhood, right? That's where the WallStreetBets people, a lot of them use it, Robinhood as a brokerage. And so what Robinhood did with their trading hold is essentially limit the buy orders. And so when you look at the order book, there just wasn't many. There weren't many bids. There weren't many people trying. There weren't many orders to buy because they couldn't. Right? They couldn't. They had to go to the New York Stock or any other broker or any other platform wherein you can trade aside from Robinhood. But a lot of people have their money and it's locked up and whatever. But the sell side didn't change. So all of a sudden, on the buy side, you've got the order book completely drying up, and it doesn't take much money to move the price down. Because again, if you have even just one or two sell orders, right? Only one or two people want to sell one or two stocks, or specific whatever amounts of money. If there is no one willing to buy at 100, it's going to go down to 99. If there's no one if there's no one willing to, if there's no one able to technically buy at 99, it's going to keep going down. At 98, the same, up until 50, where some random other guy, or not random, but some guy on another platform, is now willing to buy GameStop because whatever. And that's when the price fall stops. And that's why when Robinhood halted their trading, in essence, the purchase of these stocks and some others, not the selling, that's why the price of GameStop, for example, just plummeted 50%. And that's why, essentially, you can make the argument that what they did with that trading hold is market manipulation. Now, whether their intent was to do that, that's a whole different thing, because Robinhood has their own reasons for specifically protecting their financial liabilities, as I'm going to go into in a second. But the idea here is Robinhood closed the tap on the buy orders. There was no buy orders or very little, and there was little money needed to move the price down and essentially recover the losses of the hedge funds, whilst screwing over some of the Redditors or people on the other side of the transaction. Okay, so that's essentially that from the order book. I will now play Robinhood CEO's some essentially appearance on CNN and how he talks about the reasoning, the reason that he gives. I will only play a minute of it because, as you'll see.
I want you to address the obvious. This looks like a move by an outfit called Robinhood, which is supposed to be taken from the rich and given to the poor, and doing exactly the opposite. That when the big guys, including one of your main investors in your company, started to lose, you shut down the game to starve the little guy. Fair criticism.
That's not what it is at all. And I know you started this segment. It really resonated with me because you described the story of Robinhood. Robinhood started 5 years ago by pioneering commission-free, no-account minimum mobile investing. And we've been the spokesperson of the individual investor. And our whole goal as an institution is to enable those customers, empower them, and give them access to the markets, because for the longest time, markets have been only accessible to the wealthy. And so the entire industry adopted our business model in 2019, and in 2020, we added millions.
Right. So you get the idea. He's not the best spokesperson, ideally. I mean, this is kind of the idea which really encapsulates. I'm going to stop sharing my screen. Actually, no, keep it on. I'm going to play another video in a sec. But what the Robinhood CEO here did is that he wasn't able to give you a short answer, so he gave you a long one instead. The problem, which is going to be illustrated by another video in a second, which I'm going to talk about, which also affects Robinhood and other brokers. But before I go on to do that, when it does come to market manipulation, it's difficult for, big, whether that's CEOs or whoever you saw in the media over the past few days, regulators, some regulators, crying wolf over market manipulation when they themselves, as I explained by the order book, very much manipulated the stock price. And again, this is, I believe, the technicality and the mechanics of what happened. I'm not here saying that the Robinhood CEO pressed a few buttons and watched the price collapse and was happy. By no means is this an easy situation for him. He's in a lot of deep shit. Again, we're going to go into that in a second. But it's problematic when he tries to, as a Robinhood CEO, as these brokers try to balance their own financial liabilities with essentially without then manipulating the markets. And I think when the SEC talks about regulation and when people talk about, what kind of regulation could we install from here on, it's tough to let this problem go in terms of how can we avoid brokers caring for themselves and the integrity of their business without then, if it's possible at all, affecting the market at large. But what we saw from the Robinhood CEO. Oh yeah, and also I wanted to say, because of the exposure of these hedge funds and potentially Citadel and whoever is genuinely losing, I wouldn't have I could imagine that on the day where Robinhood did hold the trading, this CEO guy got a call from whoever it might be, and whoever called said, if you don't hold your trading right now, you're never gonna fucking find a job on Wall Street ever again, and I'm gonna make sure of it, right? Because whoever is losing the money is losing a lot of money. And not only that, if Robinhood again was to keep buying open as they did with selling, the price would have continued to go up. Because a lot of people behind this, when it comes to WallStreetBets, they're here to send a message, whatever the hell that means. A lot of people don't know what they're doing is an actual short squeeze. I wouldn't assume they know what they've heard the phrase because it's on the news and they're involved in it. But if you sit a Wall Street better down, the average, maybe not average, but whoever is investing into stocks and not even options, but actual stock of GameStop, if you ask them about the mechanics of the short squeeze and whether they know if a pump or dump is legal or not, or whatever is it, what is their intention, they won't have a clue, which is a problematic situation. But that aside, the Robinhood CEO here essentially communicated in a terrible way to the public that they're trying not to go broke, because that's what this is about. And Robinhood, because of this, has become an incredible case study of the fragility of the brand, which is going to be studied in the future. It's important to see how this is it's important to study this essentially. But like he said here, he's trying to, like the CEO said in the video just now, they're trying to provide market access to the individual investor. Hypocrisy. They're trying to the entire name. That's the big funny, sad and funny irony of it all is Robinhood is meant to give from the poor, from the rich to the poor, but they're now taking from the poor, potentially just the individual retail average normal person investor to the rich by that. Again, we saw how it could have changed and manipulated the market. We can't exactly justify, and this isn't something that we're ever gonna know. We can't justify that Robinhood's intent was to just tank the price. But you permit selling, you don't allow buying. It is in a nutshell, very much so obvious what's going to happen to the price. The second video, which I want to play now, is from the Interactive Brokers chairman. It's another brokerage, and he explains quite well the specific risk to these brokers and what Robinhood's CEO should have said when it came to their own financial liability and them trying not to go broke.
Intermediaries and the clearing houses. I hope that you'll audience can follow this. For every option trade, there's a buyer and a seller. There are as many long options as there are short options. So when the stock moves either way, some options make money they on one side, and the other side they lose money. The broker stands between his customers and the clearing house. So when some option holders make money, the clearing house has to give us the money to give it to our customers, while other option holders, sellers or buyers on the wrong side lose money. We have to collect money from them and give it to the clearing house. If our customers are unable to pay for their losses, we have to put up our own money. Now, luckily enough, we have $9 billion of equity, so we don't have a problem. And we also have a very well automated risk management system, so we haven't really gotten hurt. However, I cannot say the same thing with full confidence about other brokers. I really don't know where they stand, so I'm extremely concerned. As GAME moved from $17 to $500, there are roughly 3 million contracts outstanding in the options market. If one of those options is worth, say, an average option I estimate worth about $10,000 now, so that is a loss of roughly $10 to $15 billion on the one side and $10 to $15 billion of gain on the other. I'm afraid that there may be brokers who may not be able to meet these margin calls.
Yeah, so this is the brunt of the problem which the brokers face, and it's one of the sides of the debate that is very much, I think, missed on WallStreetBets, or at least on the side who's winning, quote unquote, winning and gaining from this, or is set to gain specifically. So what we're seeing here is that, in a nutshell, brokers have higher costs associated with higher trading volume, with respect to the clearing houses and volatility as well. And the way to satisfy these costs is that they need to hold essentially, or they need to meet some liquidity requirements, and in one way or another hold some reserves. And when the orders go up and when there's higher volatility, not only do they need to keep higher reserves, but the clearing houses then also require more reserves on top of that. So, for example, if initially, I think it was Robinhood, as per the clearing houses, needed to have some sort of reserves to cover 1% of the transaction, 1% of the trading volume in dollars or whatever. Now the clearing house, because of the volatility, is requiring 5 to 10%. So trading volume balloons, the reserves required, and the volatility does so as well. And so this is the problem which the brokers are faced with. As the chairman here said, 10 to 15 losses on one side, and 10 to 15 billion US dollars losses on one side, and 10 to 15 billion dollars of gain on the other. And if hedge funds, if whoever is short cannot meet these payments, the brokers then have to give out the money. And for a big broker like IB, this isn't quote unquote a problem because of the risk management systems and also $5 billion US dollars in equity. I'm paraphrasing, but as we just saw, that is a reason whereby IB interactive brokers might be a bit better off in this troublesome period, or at least for the time in which the transactions are essentially executed, right? So for the time being, before stocks are bought or sold, or options are bought and sold, these reserve requirements, liquidity requirements have to be met. The costs there's a certain risk which is carried by the clearing houses and the brokers, and for that they get the risk premium, right? That's also how they get their money. That's kind of their, they're getting paid for the risk of holding and transacting and executing. And so that's essentially the problem that these brokers face. And so Robinhood, for example, did halt the trading, not because they hate you, not because they hate WallStreetBets necessarily, but because they might go broke if they don't. That's the big problem, which I don't think is being talked about enough, right? We talk about, market manipulation and order book analysis, but we don't then talk about the clearinghouses and how these brokers, which aren't necessarily the bad guys, how they operate. And it's important to point that out because it's so crucial in this debate. And so whereas it's important to, not important, whereas it's fun and cool to talk about the memes in a short squeeze and we're going to be rich, we're going to eat the rich, you have to set that aside and then also talk about the system and the integrity of the system on the other side, right? Are the brokers, are the other side who's losing actually going to be able to pay me out the money, right? Because now it's a case of, okay, how many brokers have bad exposure, some exposure to this problem, whereby not only the hedge funds are going to go bust, but maybe the brokers are also going to be bust. So you, the Wall Street bets, are victorious in completely fucking like crashing the system, and maybe not getting your payout that you deserve, aside from the people that sell into the rally, right? This is the brunt of the problem, and it's so multifaceted, and it's so multi-pronged also, the extent to which people don't realize, right? And it takes time and analysis and reading. And for example, myself, I'm not invested in the stuff that I'm talking about, so I'm not here to promote one side or the other. I'm here to kind of analyze what is going on and bring to you this in words and writing, and the kind of this vocal way, this spoken way of analysis that I'm providing to you, and not necessarily saying whether you should go long GME or whether you should go short GME, because that's not the point of this discussion. Very much a one-sided this discussion, but nevertheless one-sided in terms of one way. I'm just speaking to myself, really. That's what I mean. But yeah, so that's why when these brokers talk about protecting the customers and protecting the market, they mean about, yes, they're obviously talking about protecting themselves, right? This clip of the Interactive Brokers guy was split up into him announcing how he's worried not about the integrity of the market, but what I just showed here, but split up into the part where he says, I think just after this actually, where he's just worried about himself and the brokerage. Yes, he's worried about that, because without the goddamn brokerage, people don't get their payouts and money doesn't get to, the market isn't made. And so that's the big problem, and that's the systemic risk which we have seen. And it's, this is to a certain extent a bipartisan issue in terms of keeping the brokers or keeping the system alive. That doesn't mean you should go to whatever extent to save the system in the idea of you preventing destruction, but you need to promote the efficient functioning of whatever we have here built up. You want to make it efficient, you want to make sure it's fair, and win is win and lose is lose, I guess, if you're, not just a free market guy, but a fair guy. But yeah, the idea here is that this is a side of the argument that hasn't been so out wildly spoken, but nevertheless is as equally important to talk about as the greatness, quote unquote, of the Wall Street Bets prank, or whatever you want to call it, the short squeeze. I saw some Ben Shapiro video talking about the greatest prank of, Wall Street Bets on Wall Street. It's not a prank. This is, you can argue that it's a pump and dump. You can argue that these brokers and hedge funds can go bust. And, soon enough, you won't have any rich people to eat from if that's what you so wish. So, so please. But that aside, that's kind of where you get into emotions and, these kind of cool YouTube video titles, or headlines or whatever you see on the news, which completely forego the holistic nature which has to be covered of this problem. But, my speech aside, we can now move on. What else has been also in the news is, I'm going to stop sharing my, actually, I'll keep it on. What else has been on the news is now the talk of these unsophisticated and amateur retail investors, right? These complete idiots, people who don't know what they're doing, who have essentially taken multi-billion US dollar amounts from the hedge funds. These idiots, these unsophisticated investors. Obviously, I'm kind of joking, but the problem here that we face is now defining an unsophisticated investor or an amateur investor. Now, obviously, someone investing for the first time, you might argue that is an amateur investor. But when we talk about retail has been doing okay over the past year from, since the pandemic. For example, they invested prominent, quote unquote, retail investment has been going into airlines because they were cheap. When Warren Buffett sold, that's when a lot of retail went in. And that's, I think, outperformed the market. So, they're starting to get a good track record. What else did they've been prominent investors in Tesla and in Bitcoin and other cryptocurrencies. And these free investments, one of many available in the market. I mean, these are just the successes, obviously. They've been very successful it's selection bias, but it's still, if you're trying to judge a sophisticated or not investor by its track record, retail has been doing okay for the past year or, around that time. But then if you're trying to, then segregate investors based on how long they've been in the market in terms of like the track record over a period of time, because we know the hedge funds have been, and they've been underperforming the market at large for some time, obviously, when you look at the longer perspective. But then, with retail, the kind of question is like, how do you define an unsophisticated amateur investor? I kind of lost my train of thought, but what is interesting here, and some of the criticism that comes at these unsophisticated quote-unquote idiots that don't know what they're doing, is essentially how they're, can we accuse these guys of collusion with this kind of public forum, WallStreetBets? And then the question becomes, well, okay, first of all, as it pertains to collusion, you have to show malintent and specific grouping and bundling of individuals saying, okay, we're gonna, for example, manipulate the order book by just going buying at this specific time and moving the price up and being rich, this, that, and the other. You have to prove that. But when it comes to whether these guys are colluding, should you be able to talk about investments, this, that, and the other, I think this debate is being misinterpreted or at least misrepresented. And this is because of that. When it comes to communication between different investors and players in the market, that's been happening for a long time, since the 80s and the 90s on Wall Street. When they're even today, when it comes to like the Bloomberg terminal, you can go on if you have one, you can go on the Bloomberg terminal and go on chats with investment bankers and different finance professionals. You can go to ideas dinners, quote unquote, which investment professionals have. It's the same idea, it's the same premise, just on the internet and available to now everyone. Essentially, anyone who wants to join WallStreetBets or any other investment communities or public forums, they can. And this is the same as the tool of communication which investment banks and Wall Street has had. Just it's come about more recently than it has for Wall Street, which they've benefited from for a long time. And again, you're changing the name tags and labels of everything, but the basic mechanics of communication have been much longer present in Wall Street than they have been at WallStreetBets, for example, or Reddit. So that's a weak argument. And this is essentially the idea of technology now the internet at large, leveling the playing field in terms of communication, as I just mentioned. Then in terms of data as well, you could go onto Google and go onto different websites. And since you find yourself the access to whatever it is data you can imagine, like whatever filings, anything from the financial statements of these different companies to then specific reports and analysis on sites like Seeking Alpha or whatever it is that is mainstream or mainly used, let's say. And so there is access to communication. There is access to data. And now there's also access to markets in terms of like Robinhood and frictionless trading. And there's frictionless access to both communication, data, and markets because of technology and because of internet. And it's only been slowly catching on. But this is a big macro trend, big macro trend in terms of changing how the financial, how we function as humans, not only function as humans, but essentially the entire fundamental of finance, right? Because now everyone can communicate and group and talk and to trade and learn, right? Learn, analyze, whatever it comes to that. Wall Street has had that because of agglomeration in terms of Wall Street itself. And, like I said, going out for coffees with different investment bankers and going on the Bloomberg terminals. Now everyone has it. And now this is essentially what the free market provides in terms of knowledge, right? Access to markets and then the ability to execute if you so please. I think also something else that's really important to talk about is the effect of the pandemic. Because like I said, this trend of retail outperforming or at least doing much better than it has in the past and becoming more recognized in its successes, quote unquote successes, if that's how you define success, it's come about during the pandemic. And you have to realize now the landscape that people are playing in, especially because of COVID, you had a lot of people unemployed, maybe working part-time, maybe even just working from home, learning from home, online education like myself. I am, I'm a student and I've been learning from home. Some people might just have, in general, more time on their hands. Not only that, they need to make money. especially if you're working part-time, or you still got liabilities like education and university, you don't have a job, you're going to need to make income. Saving is not an option because saving hasn't been an option for a long time. And we've been even told this, not only by the low to negative interest rates, depending where you are in the world, but then also, well, hedge funds and investors, and saying how we should invest in the stock market for guaranteed 8% annual returns, this, that, and the other. Well, then we have started doing that. And I say we, I'm not trying to become a populist here, but the idea is that you have to ask yourself, how many of these amateur, unsophisticated people with more time on their hands because of losing a job or working only part-time or learning from home, operating from home, how many of these people have actually spent the past year really learning their shit, really using the data that's available, finding these forums, improving their financial literacy, starting to trade, figure out a strategy that works. It has taken everyone by shock because of, let's say, short squeeze. And short squeezes have been around since shorts came about. This isn't anything new. This isn't a new invention. It's a reinvention, if anything. Because these are completely, when it comes to WallStreetBets, these are like completely decentralized. Like they're all individuals. There's 7.5 individuals working together somehow. How do you do that? I mean, without getting into Homo sapiens and how essentially societies function, it is an incredible feat, and I guess one that wasn't imagined before that. Again, it's such an interesting social interaction, but it's come about because of, in my opinion, technology and the internet, and us as humans, kind of looking towards social interaction and coming together as a group, working together as a group, being in general cooperative bunch, and executing on this, right? So again, it comes to the idea of like, okay, you're calling these people amateurs and that, but these amateurs and unsophisticated investors have fucked you out of 10, 15 billion US dollars, right? And so, of course, hedge funds can cover this. There's no problem in, looking towards credit lines, this, that, and the other. Brokers, especially smaller, newer brokers as Robinhood, that's a different topic and one that isn't insignificant. But again, also what's interesting that's been cited in WallStreetBets, if you go on the subreddit and have been active at least over the past 2 weeks of this stuff happening, a lot of people have been citing the resentment that they have to not just the rich and the system and, like the Fed kind of printing money, whatever it is that might trigger some people or annoy some people, but even resentment to 07 and 08, that there were stories posted about some guy's father losing his business and forever since living a problematic lifestyle, essentially. And you saw a lot of people give their own stories, and fake or not, you want to assume that these stories are true and people are being genuine in what they're saying. That, of course, everything comes with a grain of salt, as we know. But nevertheless, it's the idea of like, okay, not only have people have had the time and the actual kind of push towards learning this stuff and making money and figuring out the financial markets over the past year because of the pandemic, some people might have been working on this for a decade. Working on themselves, working on them skills. That's an interesting way of approaching this topic, and one that kind of sheds light, as opposed to what some people might assume in terms of these unsophisticated idiots just colluding, or manipulating the markets. Like, really, you're going to cry wolf with market manipulation? That's stupid and ignorant, and it's even offensive to the people who are listening. That's the kind of idiot that you take me for. Whatever. But yeah, that's kind of the problem of talking about sophisticated and unsophisticated investors. How do we define that? Now is the question of what happens next. There's been talk about regulation. There's been talk about let the free market reign, protecting retail investors the way Robinhood did with their trading halts, and the way SEC has said they're going to be protecting retail investors, just the same way they did perfectly fine in 07 and 08, fantastically, even I might add. But when it comes to regulation, I think you cannot regulate away the nature of humanity, of humans, as I kind of see this exactly, quote unquote, problem to me. What we're seeing now is, again, a trend is people just accessing information that's been out there and it's been accessed by the Wall Street. Coming together with humans and kind of spending the time saying that, hey, money can be made from this. I'm going to learn this financial markets and these financial literacy things. And so can we regulate this away? I don't know. And I don't think we should. Because how can you regulate? Are you going to only allow sophisticated investors to trade? Okay, how do you define that? Does someone have to go through a course, the CFA, level 1, 2, 3? Are you fucking kidding me? Do you have to do an economics degree or finance degree? That doesn't predispose you to being a sophisticated trader. That just predisposes you to nothing in particular, whatever. So it's hard to regulate because I think it's such a nature of just a force of nature, than it is of just a market inefficiency. It's a market efficiency, actually, I would suggest. But the market efficiency, that doesn't mean it's good. That's not what I'm saying. Because what might happen here, and from a conversation that I had earlier today, very interesting point, what might happen here is that you might see WallStreetBets elites come about, and the same split that we see in Wall Street and Main Street or retail, we might see in WallStreetBets. Because especially when it comes to, like, for example, deep fucking value, if you've looked at his bio, if you looked at his profile, I'm pretty sure he's already cashed in some of his money, and he did so in the past. He's made his money. Other people have also been selling into the rally, because for some new fool to come into WallStreetBets and think that everyone's just going to hold and we're all going to live happily ever after, and that everyone's going to make money and only hedge funds are going to suffer, they don't tend to lose. It's problematic because some people are going to win, some people are going to lose, and that's the reality of it. And, you know, some hedge funds and institutional investors might win and some might lose, right? That might be the case. But it won't be hedge funds lose and WallStreetBets wins. That is not going to be the case, 100%. In fact, it's just going to be a split. In WallStreetBets, some people are going to sell into the rally. Some people definitely sold last week. I don't know what's going to happen next week, but you could have made good money if you just, let's say entered in at the start of this trend and sold last week. You've secured your bag, bro. That's it. Some people have been saying that they're buying GameStop to send a message, not necessarily to make money. Okay, well, with that mindset, you won't, because that just sounds like a religion, like a cult. They're all believing in some fiction. Stick it to the rich, this, that, and the other. Okay, your $600 and your 10 buddies who have also invested under 1,000, you're going to lose. And this accumulated is going to be in the the wallet of some institutional investor or some guy on Wall Street who sold the day before you, the hour before you. It's going to be the reality. And I think that's also what we need to protect the people against. When you talk about protecting retail investors, that's what you need to do. But you can't protect them through regulation. I don't know what regulation does that's going to inherently protect everyone and make sure nobody loses money. Nobody loses money, because that's not how financial markets work. That's not meant to be how it works. It's a zero-sum game, essentially. But I think that's why you should educate. I don't know. Bolster your degrees. Have financial literacy courses. Let people access professional advice. Let these people have access to, for example, it's not like regulators are not permitting it, but it could be cheaper. It could be more accessible. It could be more promoted. Financial advice could be more of a free market and therefore cheaper in the utopia, whatever. Because if people have access to advice and someone more into the markets and more knowledgeable than them, and there's a lot of those people, they might make more rational decisions. Now, we know that the market, in and of itself, isn't exclusively efficient, and and it doesn't work in a way where, again, people only gain, but it's important to educate and not regulate, I think. But we're going to see how that goes. Again, when it comes to like professional advice or whatever, I definitely it's going to change. Unless the hedge funds or, if you want to throw that argument, if the big players don't lose a lot of money, nothing's going to change. Because protecting retail investors and regulating retail investors, I don't think that tackles the core of the problem. And again, in my opinion, it's not as much as a problem as it is indicative of a more level playing field. Access to data, access to communities, access to the markets, and people just figuring stuff out, these traders, these investors, whatever. All hail the internet. But we'll see how that goes. It's definitely not an event which will leave a lot of people happy. In the moment, I think a lot of WallStreetBets people are gonna think, We're sending a message, stick it to the rich. Although I've lost my $600, I've stuck it to the rich. And the week after that, they might think, fuck, that was actually kind of stupid. I won't do that again. It's a process of learning when it comes to investing. But nevertheless, should that have not happened in the first place thanks to regulation? I don't know. Who's to say? Not me. But that's that. That's been the show. If you'd like to hear, read, and check out more of what I have to offer, go to investingintellect.com. I will be live streaming more and making more of these videos and podcasts. This has been quite an interesting conversation from me to myself, me to my wall. But nevertheless, stay safe, stay diligent, do your own research, and try and keep the emotion and lack of just reason justification, two of the same. Actually, I don't know what word I should end on. Do the research, right? Try to stay justified. And don't try and follow cults or ideas or the fiction of sticking it to this or sticking it to that. Or don't believe just the fiction that Robinhood hates me and therefore they halted their trading. Because you are not as important as you might think. You're not as much of a main character in your life as you might think. And that just causes you to work hard. Work hard and know your stuff. And a lot of people haven't done that. And they're going to pay the price. But that's that. Investingintellect.com. Have a great week and goodbye. Cheers. I did not end the broadcast. I left the broadcasting studio. Have a great week.